Right, I think we'll kick off. We're just about approaching 10:30 on this our 10th webinar, which seems incredible to think that we've been going now for 8-9 weeks and we're on our 10th. But hopefully we continue to add value to everyone across dealers, OEMs, and other advisors in the motor sector. I think it's a bit of a continuation of theme today, not unsurprisingly, where we'll be focusing principally on the return to trading aspects again and operational aspects, an update from John Pollock on things like click and collect, government's guidance on the aftermarket, vehicles and also used valuations. And then we'll move into, from there, risk assessments, health and safety, COVID-19 secure, and insurance, director's liability insurance and John Beveridge and Leigh Cohen will be covering that. And then we'll go around our normal kind of agenda items across from funding to the job retention scheme, property, cyber tax, etc. So as per normally, we will be having a recording of this webinar, so we will share that to everyone by the end of today and an executive summary out at some point tomorrow. So I shall now ask John Pollock to kick off with our operational return to trading update.
Great. Thank you very much, Steve, and good morning, everybody. On last week's webinar, we covered the return to trading guidance for dealers, which had just been issued by the government. And of course, that was in the category of non-essential retail openings. An outstanding question at the time was whether click and collect process was allowed ahead of the kind of formal return to trading date of the 1st of June. Now, many of you would be aware of the latest update, but for the avoidance of doubt, the NFDA, in conjunction with other industry bodies, including the SMMT, has confirmed that although physical car showrooms should, of course, remain closed to the public, pending further developments, obviously, dealers are entitled to offer a click and collect service at dealerships for vehicles purchased remotely. So provided dealers follow strict social distancing and hygiene protocols at their sites, and of course providing that customers do not enter the actual car showroom to organise or complete the collection, customers may visit dealership premises to collect purchased vehicles, as well, of course, to drop off vehicles for repair, servicing, etc., and of course to collect them post-repair, servicing, etc. So while it is up to each dealer to decide what collection or delivery formats best suits your operations, the NFDA would suggest that handover paperwork is completed on the dealership forecourt or in the dealership parking area. Yeah, and of course, an appointment system is used wherever possible, with appropriate social distancing, of course, in place. Maybe just worthy of note that the NFDA guidance has also followed engagement with trading standards as well. So by following effectively that guidance, you should meet all criteria from all potential audit bodies. Quick point of note, following the publication of lockdown exit strategies for England and Northern Ireland, the Welsh Government has now published its plan for exiting lockdown in Wales. The plan includes a traffic light system to represent the broad phases as it starts to move out of lockdown, and the plan indicates that non-essential retail would be permitted to begin opening as part of their amber phase. They're currently in red, so no specific date as yet, but could be a week or two behind England in terms of dealer opening times from the 1st of June. New automotive sector-specific guidance for aftermarket providers has also been published by the combined bodies of the GEA, the IAAF, the IMI, the SMTA, and the SMMT. MOT testers and service repair sector can welcome back more customers now, assuming, of course, they also meet the comprehensive COVID-19 safety measures across all points, touch points with the customer. The sector has stated it can cope with a significant ramp up in demand, but has called as part of this change for the end of the 6-month MOT extension as soon as possible. So workshops have been allowed to stay open, as you know, throughout the lockdown to help keep vehicles roadworthy for essential journeys. The new guidance will help companies of all types and sizes in the aftermarket to operate safely, while of course minimising transmission risk. The best practice guidance covers the entire aftermarket sector, including workshops, warehouses, mobile operations, and parts distributors. It covers every aspect of their operations, from communication, customer delivery, collection, etc. And of course, it is designed to complement the government advice and guidance, and can be found, obviously, on all of those bodies' websites if you need to refer to it. Now, with government advice stating that workers should avoid public transport when returning to work, obviously the use of private cars could well rise fairly sharply. This, of course, is potentially good news for everybody, including the aftermarket sector, which is a main contributor within the automotive contributory area for the UK economy. And of course, we're all jointly supporting up to kind of 40 million vehicles on the road in the UK. So significant opportunity if we can get the support right and meet the guidance and get back to trading from an after-sales perspective. Final piece on guidance is around the government guidance that was issued last week for vehicles. So again, you're probably up to speed with this, but if you're not, it is worthy of just taking a quick look and worth checking. It's pretty straightforward, no real surprises. As I mentioned last week, it's about 80%, 85% commonality across the individual area guidelines, but there's a few points of note in there for vehicles, vehicle usage and delivery and drivers. Most of it's fairly sort of common sense, so avoiding multiple occupancy, single person or contactless refueling, using physical screening, provided this does not compromise safety, for example, reducing visibility, and of course using a fixed pairing system and including electronic pre-booking and paperwork and non-contact deliveries, including a safe exchange of paperwork process. And of course, a big focus on managing contact of the vehicle and the individuals in terms of sanitation procedures for all deliveries, etc., for inbound and outbound goods. So again, just worthy of checking if you haven't already paid note to that. Okay, so just before we move on to used cars and an update in that sector, just a reminder that we have sent out the alternative PPE, safety and tech supplier list this week. And if you do need any further information or you're having trouble kind of opening any of the zip files or whatever, then please do get in touch with us and we can send you individual brochures if necessary as well. So just let us know if there's any issues in that regard. So moving to used car sales, obviously growing volumes now of used car sales kind of at the end of lockdown and just coming out of lockdown have now prompted CAP HPI to recommence their valuation changes. And they initially suggest, initial sales effectively suggest a decline of between -2% to -5%. No changes to used car values were made, of course, by them during the lockdown period. So on March the 24th and May the 10th, they stated that there was insufficient data to do so. And indeed, they also joined with Auto Trader in suggesting that car retailers' efforts to cut values to boost the market during the lockdown period would not be very effective in terms of sales generation, or indeed, of course, in terms of stability for RVs coming out of lockdown. Now, following recent guidance, CAP HPI has now said that their statement is that the used car market is showing some slow signs of recovery. Data volumes, which were up around about 70% in the week commencing May the 4th, compared to 2 weeks earlier, as I mentioned, suggested a downward movement of between 2 to 5% for some of those models and ranges that are older than 5 years old, which is an important point to note, obviously. Darren Martin from CAP, head of valuation, said that the previous 5 years have seen an average drop of around about 4% during April and May, round about the 5-year-old vehicle age point. And indeed, last year was as high as 6.3% during the same period. So the movements that they're currently seeing in the middle of the pandemic are, to use his words, by no means seismic. But of course, they're reflecting data that is relatively slowly growing in volume terms. Automotive management also reported this week that aging stock has understandably been cited as the main driver of the predicted pan-European used car retail losses in the region of 1.2 to 1.5 billion losses, between £1 billion worth of loss across used car values between the start of the lockdown in continental Europe and mid-April. Now, Auto Vista is the source of this data, scenarios for the residual value development in Europe for this year and looking into next year and beyond. This is a white paper that they've just issued. There's detail that the scale of losses incurred by the sector in the opening weeks of the pandemic and the losses expected in residual values across markets should clearly consistently build as each market comes out of lockdown. Now, the SMMT reported that the UK's car market contracted, as you'll probably be aware, by minus 0.3% in the first quarter of 2020, following obviously the lockdown and the decline, the lockdown-related decline of minus 30%, just over minus 30% in March. CAP HPI said that this was now a position that allowed them to kind of confidently move values in line with market using editorial expertise rather than algorithms to analyze the car valuation changes on the transactions that they're starting to see. So initially, their statement is that they'll be looking to move values on older vehicles in the mainstream sectors, where there is obviously enough evidence to reflect current prices. And by looking at each generation of model individually, no overall market movements would be applied, which is, again, another important point to note. They also said that at the current time, younger used cars will not be moved in value, as that end of the market, of course, is still doesn't have enough data effectively to be representative. They said that wholesale records are still well below usual volumes. However, they do feel that overall there's enough data for prices to start to be reflected for the older vehicles. Again, they say that outliers and unrepresentative volumes and prices across the edges of the market will not influence the overall market and individual sector adjustments. So for now, valuation movements will only be made on cars around the 5 to 20-year-old mark, as I said earlier. And of course, they will review the situation on an ongoing basis. Now, getting back to Auto Vista's market research, this concluded that countries such as the UK and France, where the lockdown has been more strictly enforced, would see a lesser impact on residual values than countries like Sweden and Finland, where car retailers were allowed to continue trading despite dramatically reduced customer demand. And it's interesting that if you look at their current table of calculations across the main markets in Europe, we see example residual value decline since lockdown ranging from between minus 0.6% in the UK, 0.6%, sorry, in the UK, through to 0.9% across Germany, 0.2 in France, 0.9 in Spain and Italy, and then averaged across the big five minus 0.7%. Now, obviously, that's based on relatively low volumes from a reporting perspective, but gives you a bit of an indication as to initial movements in April across the continental European markets. So that's the initial update on used cars. Let me just give you a flavour for some of the global updates that we've seen across the last week and a half. If we start, as we normally do, by just having a little look at China. So the Shanghai Auto Show, some of you may have seen, was held outdoors for the first time, amidst cars emblazoned with heavy discounts, and of course shoppers in face masks, and most of the point of sale and interactive materials being obviously digitally focused. And this is indicative really of sort of China's auto industry starting to come back now, but it is in fits and starts, although there are green shoots. So we have automakers in China now resuming output. Dealers, of course, have reopened across the market. And as I mentioned previously, in April, new vehicle sales rose for the first time in nearly 2 years, climbing 4.4%. But the industry is changing, as we've also touched upon. I've mentioned the pop-up auto shows now. That's rolling out across many of the main cities in China with these outdoor-based shows. And of course, online is a significantly growing area of business for the Chinese market. So VW Group CEO Herbert Diess in February became, in fact, the first leader of a global automaker to open a blog effectively hosted on Weibo, which is the Chinese most popular micro blog site. And that's deliberately done to pitch products and services. So if it's good enough for the Volkswagen Group CEO, I think it's an indicative example of a trend moving forward. Car dealerships, as we know in China, are already embracing online marketing and sales. At the end of March, nearly a quarter of dealerships surveyed were using live streaming services for sales and marketing. And indeed, other Volkswagen executives have said that a new kind of Chinese customer is emerging, particularly driven off the back of the moving away from public transport. Many indeed of these buyers are first-time car buyers, and in fact that first-time car buyer rate is currently being seen in China at around about 60%, which obviously is very high. There is a belief that the lockdown will have a catalyst-like effect on long-term change of digitization in China, and again Volkswagen are commenting on building on that platform to enhance their connection with customers, particularly at a dealership level, using predominantly digital-based communication systems. And again, they highlight April's new vehicle sales as being an indication of sustainable growth coming back in China. However, if we look at the first 10 days of May, new vehicle sales fell by some 14% compared to a year earlier. So it is very much a fits and starts market at the moment. So just a few closing points around the rest of the globe. So in Europe, some of you will have seen that Fiat Chrysler Auto confirmed that they're in talks to obtain a state-backed credit line of just over 6.3 billion euros, obviously designed to buttress their finances against the downturn. They're seeking to shore up liquidity after burning around about $5.5 billion worth of cash in the first quarter, and obviously plants were in shutdown. And the loan would be the largest financing guaranteed by a European government during the pandemic, after Renault's €5 billion deal that was agreed last month. Interestingly, getting a little bit closer to home, Bentley CEO Adrian Hallmark has said that China's rebound from coronavirus-induced lockdowns has been astonishing. In 1 week in April, the Bentley order intake was greater than any individual month in the previous 6 months leading up to it. And Bentley, of course, restarted their production at their factory in Crewe on May the 11th. A few last points. In the US, FDA and GM have all now returned to production. However, they are grappling with many supply-related issues, particularly as a result of sort of parts delays from Mexico. And in Japan, Toyota have said that they will reduce their vehicle production by 122,000 units in June. And this is due to current lack of demand, but does allow it to keep its plants running on limited operations. Toyota said that the reduced output represented a 40% cut from the original plans for June production. And of course, some of you will have seen that McLaren, of course, are looking into various funding options to help the automotive and Formula One parts of the business. Sky reporting that McLaren was seeking to raise up to £275 million by borrowing against its working headquarters and its collection of historic race cars. And then lastly, the latest global new car sales forecasts for 2020 came out last week. They're set to drop to 69.6 million units globally. That's a 22% reduction on average compared to 2019. This is according to IHS Markit. The forecast for China sees a volume at 21.4 million, which is a 15% drop year on year. Although their forecasts for 2021 see an increase back up to just under 24 million. So again, much more of a V-shaped recovery anticipated there. The forecast for Europe sees sales fall to 25%, to around about 15.5 million units, and North America set to drop by 26.7% year on year, which would take their market size back to 12.5 million units. That closes the update for today. I'll hand you back to Steve. Thank you.
That's brilliant. Thank you, John. Very, very comprehensive. Ben Green, any brief update in terms of e-commerce?
Yeah, so kind of following on from what John said there, obviously, when I spoke last week, we were just at the point where Boris was making the announcement that the lockdown would be extended. We weren't entirely sure how that was going to affect the digital engagement that we'd been seeing grow since the 8th of April, which, as I mentioned before, is really the lowest point during the lockdown in terms of engagement. There were two ways it could have gone. Either the engagement goes up, or potentially with people believing they're going to be in lockdown for longer, it goes down. It went up and quite considerably. And some of the areas we've seen real growth in terms of engagement is in telephone calls. They're up 44% now. So significant rise in that. Service bookings up 79%. Obviously, for a lot of people, that's just for need. They've been putting it off, but they want to get it back going. And transactions, as we've been talking about with the e-commerce elements, has just continued to grow. In fact, we saw a peak last week of 118 transactions in one day. Bear in mind, at the start of it, we were looking at around 25. So it's not numbers to replace what's there, but the growth is huge. And I think the important thing with e-commerce is if people have a good transactional experience, obviously they will tell other people and it will continue to grow. But it's averaging around 96 transactions a day in the last 7 days. So it's certainly growing there. Another indicator that we're seeing digitally that people are more encouraged to buy is online valuations being done. Obviously, people needing that for any kind of part exchange kind of aspects. And that's grown 66% since the lowest point. That's one of the ones that really dropped off a cliff, and we've seen it come back quite strongly. So generally, in terms of the stats, very positive. Also, to follow on from what John said about in China, live streaming, shop streaming as it's called, is a thing that was being talked about earlier in the year. And I've been looking through some of the digital trends that are being talked about in terms of post-coronavirus lockdown activity, and shop streaming is certainly one of them. I spoke last week about virtual test drives. Obviously, that's a very one-on-one experience between the consumer and yourselves, but shop streaming is a bit different through live streaming, social media, etc. Is putting out a range of your products to say what you've got in stock, some of the features, picking out some really good players, and people can just engage on there. Obviously, you can record it and people can watch it later, but a live streaming event to be able to see what's going on seems to be the way things are going. And also, again, off the back of what John's saying about click and collect and so on, a lot of talk about the implementation of kiosk-based systems to actually link up the digital inquiry to the actual collection, particularly around after sales, looking at, the idea of being able to drop your car off using maybe an app to register with the kiosk device that it's your car, telling them which bay to park it in, digital secure key boxes, etc. And similarly then being able to pick it up without actually interacting with anyone at all, being able to pay for your servicing online. And we're certainly seeing a lot of people talk about these kiosk-based systems seen over the last couple of years. McDonald's model moving more towards that. They can be antibacterial and antiviral as well. So with the surfaces, obviously they will need cleaning, but it's better than actually linking up with other people. So I think we could see the rise of the app in automotive potentially in the next year or so. Apps have always been a strange thing. App retention rates across the board are very, very low, surprisingly low, even for products people are using regularly. And the automotive, obviously, with you not needing to link up with a dealer or manufacturer on a daily basis, app retention rates have been very low. But potentially, even if it's just through the sales or service process, I think we could see a rise in the use of those apps, because you want to connect your payment, your whole digital experience, which is obviously going to increase, to something when you do have to visit a physical space. So there's a lot of talk online about what the trends are going to be. No one obviously knows the exact answer, but certainly I think we're going to see a change in consumer behavior, and these kind of tools are going to help support that. So that's it from me, really.
That's great. Thank you. Thank you very much, Ben. And I guess linked into the return to trading and the operational aspects, health and safety aspects, and the risk assessments. John Beveridge, I know you've been talking to a few clients in your network around the risk assessment. So maybe if you could lead off on that with Leigh Cohen adding in around insurance and directors' liability, etc.
Thanks, Steve. Good morning, everybody. Yes, just a quick update on this. In terms of health and safety, obviously now a very, very crucial area moving forward. There's a couple of people we've been working with that can certainly offer advice in this area. They've got an enormous amount of experience and indeed, in one case, software that can help in this. A couple of companies, Table Manners and Vision Communications, both of whom might be known to some of you. So certainly we have close contacts with them. So if there is interest in this very, very important area or struggling really to get to grips with it, it's something we can certainly help with. Okay, Steve.
That's great. Thanks, John. And Leigh, over to you.
Morning, everyone. I guess, carrying on from what John just said, I wanted to touch on the exposures that businesses and their owners may face as we return to the workplace, in addition to setting out some considerations as we enter what can only be described as uncharted waters. I think we're all aware COVID-19 will continue to present significant risks to our businesses, and directors should be mindful of the claims that could arise from the management of these risks and take note how their directors and officers' insurance policies may respond to provide protection. Directors and officers, also known as D&O and management liability policies, are intended to protect a company's board of directors and senior officers against claims, investigations and associated defence costs relating to the decisions and actions in the course of managing the business. Many COVID-19 related claims are expected to fall within the insurance clause of D&O policies, but as all policy wordings are different, there will be certain subjectivities and limitations. I don't know whether you're all aware, but directors and officers and even employees, although perhaps mainly just senior managers, have an unlimited personal liability for decisions and actions they make on behalf of a company. These can be civil, criminal and regulatory. Whatever the case, people's personal assets are at risk by the decisions they make and the actions they take. So if you buy directors and officers insurance, you should be covered for the costs and liabilities arising from shareholder lawsuits as a consequence of the spread of the COVID-19 virus. Specifically, litigation arising from unreasonable actions or inaction by directors and or managers, economic loss from inadequate contingency planning and failure to disclose the risk posed to financial performance. Basically, where there appears to be gaps or failings in contingency plans or management response, the company's employees, customers and investors may question whether directors or senior managers fail to plan and respond adequately. From a health and safety perspective, the robustness of your contingency planning will be tested by the comprehensive nature of your risk assessment to minimise the impact of an outbreak at your business premises. So again, I urge you to follow what John said earlier and just make sure that you get, really good support there. Employment practices liability, which is often an extension to a D&O policy, is by far the most common type of directors and officers liability claim, covering such matters as unfair dismissal and sexual, racial, gender or age harassment or discrimination. Employment practices questions may arise as to whether employers have taken sufficiently timely and appropriate steps to manage their COVID-19 risks, such as enforcing safe social distancing controls in all areas, not just showrooms and workshops and service receptions, the supply of PPE, introduction of regular cleaning of all multi-touch surfaces, in addition to offering safe vehicle collections and deliveries to customers, unaccompanied test drives, and avoiding all non-essential travel. Employers will have to evidence that they have met their obligations in keeping their employees informed on all the risk assessment results, how they're managing the ongoing health risks at the workplace, educating them on good infection control, and communicate your planned response in the event of an employee testing positive for COVID-19. There needs to be a planned response. As I mentioned in last week's webinar, conducting risk assessments at the workplace is a vital step to ensure the safe return of employees. The government's new COVID-19 secure guidelines, which I urge you to download, are consistent with our advice, and comprehensive risk assessments for all areas of the business will be expected. However, You should be aware that the new COVID-19 secure guidelines go even further and state that companies with more than 50 employees should share the results of their risk assessments with the public on their website. So be mindful of that, please. From the feedback we've had so far from specialist D&O insurers, and let's remember, not many employees have actually returned to work yet, your risk assessment procedures will be tested as we face the torrent of compensation claims. People's moods may have changed. We've already witnessed this we've already had a couple of claim reports. So understandably, returning employees will be concerned for their safety or their health, feeling generally uncomfortable and maybe even angry, potentially leaving businesses, their directors and their key managers exposed to claims. Personally, I fear the re-emergence of the ambulance chasers touting for business over all forms of media, which is never a good thing. So should you find yourselves facing a potential claim, it's imperative that you take note. D&O policies will not respond if a claim notification is not reported to your insurer from the outset, and or should you fail to follow any prior written legal advice as laid out in your policy terms. As I mentioned before, all wordings are different, so I urge you to read your policies to ensure you follow the correct procedures. Moving forward, it will come as no surprise that insurers' appetite for D&O is fast decreasing as they prepare themselves for the onslaught of claims. The impact of the pandemic is already noticeable at D&O renewals, as insurers have started introducing specific questions relating to companies' exposure to the virus in order to assess their preparations. In the event these questions are not addressed to the satisfaction of your D&O insurer, they could refuse to offer renewal terms, so please, again, be mindful of that. The short-term impact of COVID-19 on D&O renewals will be increased scrutiny on the financial health of a company and the application of more insolvency restrictions. There will be questions around COVID-19 preparedness, both from a business continuity perspective, but also how a company is looking after and communicating with their employees. In preparation for what insurers believe lies ahead, at least one insurer has already ceased to accept new business whilst they review their book and their longer term strategy, and it's likely others will follow. A reduction in capacity, unfortunately, is never a good thing, as it's likely to have a detrimental effect on future premiums. In summary, your insurance policy should be your last line of defence, not your first. Comprehensive risk assessments with ongoing reviews, regularly reviewed at board level, must be your absolute priority. If you buy D&O insurance cover, your good business practices will mitigate your exposure to claims, protecting the company, its employees and its customers, not to mention the reputation and brand. If, however, you do not currently buy D&O insurance, I strongly recommend that you consider doing so. We've actually prepared a simple post-coronavirus workplace preparedness checklist, which I'm happy to share should this be of interest to you. Finally, on a completely separate matter, if I could ask those of you taking part in our business interruption recovery scheme, who haven't yet returned the completed templates, to please do so by the end of the month. I know, obviously, everyone's mad busy right now preparing for return to the workplace, but as soon as we can get this data back, the better, as we're aiming to submit the report together with the data during the month of June. Thank you very much.
Thank you, Leigh. And as ever, come on, you Spurs, of course.
Come on, you Spurs.
If we could now pass over to Greg, but if I could also ask other presenters to please mute, because there is a bit of background noise, so if you could, but over to Greg on funding.
Brilliant. Thanks, Steve. Morning, everybody. So there's a few areas to cover on funding just quickly today. So in terms of the loan schemes, let's just have a quick walk through those. I've got some more numbers on those, which I think are quite interesting. So in terms of we'll go from smallest to largest. So in terms of the bounce back loan scheme, total number of facilities approved now, 268,000, total of 8.3 billion. But the total number of applications, 363,000, and certainly we have seen a slowdown in the last few weeks of lenders processing those and certainly putting some more checks in on those bounce back loans, which on the one side is a good thing from my point of view. In terms of the coronavirus business loan interruption scheme, or the CBILS one, Total number of approved facilities, 35,919 at 6 billion, which isn't that many, let's be honest about that. And total number of applications, 71,000. So again, they're approving at less than 50%. And the larger scheme, total number of approved facilities, so that's the coronavirus large business interruption scheme, 59 only approved at 359 million from a total of 358 applications. So I think we can all draw our own conclusions from that, but my conclusion is that certainly those schemes are not working as they should be, which moves nicely onto the state aid rules or the in difficulty clause on those schemes, which a lot of clients, as we've talked about before, myself and Steve, have fallen foul of, particularly around the 2019 trading being the cut-off period. My understanding is that this is now being reviewed. There will be some changes around that business in difficulty clause. As and when that changes, we will let you know. But that has been one of the main reasons for the difficulties in getting applications through, both from the point of view of loss making, but also from the point of view of the liabilities exceeding the assets balance sheet. Moving on quickly then. So Seaballs again, particularly on this one, so up to turnovers up to 45 million and loans up to 5 million. Some movement there. We've been speaking to a number of banks this week who are now saying they've been through in their mind the majority of clients that needed them urgently for working capital facilities to keep the business going in the short term. And they're now happy to accept applications for clients who are looking to, say, restock, for argument's sake, from depleted levels of stock where you may have been. For example, we had an online used van dealer who's depleted his stock from 7 million down to 5 million, believe it or not, through the coronavirus situation. And he's still been selling. And so clearly, while he doesn't have a working capital issue, clearly when he has to ramp back up again, his stock would have been depleted. And the bank in that particular case are happy to lend money subject to the cash flow rule showing what it's for. So again, if you've been rejected, good opportunity, come back and talk to us. There may be now opportunities to put you in touch with other people that will do those loans. And there's now 63 lenders on that CBILS loans scheme. So there are more options to look at. The thing I thought I'd point out quickly is in terms of Q3, which I think is going to be a real crunch point, and I think lots of people have mentioned it previously, obviously with furlough being phased out, but again, obviously Nigel will cover a bit more detail in a minute, and he covered last week. Deferred taxes, obviously some of those will be due. Payment holidays coming to an end. Really, really important. I think this is going to be a crunch point where I think we need to keep an eye on our cash flows, constant forecasting, updating with what your funding needs are, and please keep talking to your funders. We are starting to see the funders open up and more regular funding inquiries coming through to us that we're now talking to lenders about, and there are some very good rates if you're getting in early now on things such as floor planning and asset finance, some very, very decent rates for the right business, and we'd be happy to point you in the right direction of people that are supplying those rates if you want to come and talk to us. Anything's happy to answer. Steve.
That's great. Thank you, Greg. Over to Nigel and Emma on the job retention scheme.
Thanks, Steve. So since our update last week, I did a little bit of crystal ball gazing. I was close, but no cigar. The coronavirus job retention scheme has indeed been extended, but to the end of October, not the end of September. So that's good news. It will be in its current format now until the end of July, previously the end of June. But from August until the end of October, there'll be more flexibility, and the scheme will be able to support part-time working. But that comes at a cost. So employers who avail themselves of that continued support will be required to pay a percentage of the salaries of those furloughed staff, ensuring that those that are eased back into work still get their 80% or their £2,500 a month cap. Now, we don't know what that percentage will look like yet, but clearly, good news on the one hand with relates to the two bases of the extension, but something to be very mindful of for dealers who continue to utilise this support, that it won't be free after August, and that needs to be factored into any plans around forecasting of budgets, of borrowing, of staff retention. So there will be some more specific details which we will get out to you. That's due to be released by the end of May, but we don't know exactly when that will be. But as soon as it is, we'll get some practical guidance out to you, so you know what it means, and you can continue to keep sort of planning as we come out of lockdown and move towards sort of the next norm, perhaps, rather than your new norm. Just some examples and an idea of where this is all going. So just put these in the context of, okay, what have people been saying and where HMRC going to go with this? The guidance has been clarified to say that you cannot furlough your employee and ask them to volunteer to work for you in the same or a different role. Now, to be fair, that wouldn't have even crossed my mind that somebody would do that, but clearly somebody's probably reported that into HMRC, because they're making that point. The volunteering is not to volunteer to do the same job for you, but only get furlough pay. That's be careful of that. Clearly, they had previously said that correspondence to employees need to be kept for 5 years. That's now 6 years. So they're giving themselves a bit of extra time to do some reviewing of this after the event. And they've clarified some points on non-discretionary payments, which I think ties in really with some things that Emma had previously said, but I'm sure she'll just clarify the position. But non-discretionary payments can be included in a furlough claim only where there's a contractual obligation to pay and where the employee has an enforceable right. Variable payments, therefore, in a contract that are always made or may become non-discretionary could also be included in the calculation of that 80% of wages. Got to be really, really careful on all of this, I have to say. And obviously just some clarification that non-discretionary overtime payments can be included when they're contractually obliged to be paid, and that is at a set rate or defined rate for the overtime that's worked. Again, some of this is probably common sense, really, and I'm sure Emma will come on to her thoughts on that. But they are trying to sort of clarify that I know there's been some suspicion out there about, are they looking to trip people up? I think that they don't. I think there's just a general lack of understanding for policymakers in relation to how contracts can and do work, and particularly how things might work in the sector. Obviously, the portal has been working well. We've had lots and lots of claims. It's actually snuck up on us a little bit. I don't know if people had thought about the fact that actually your claim needs to be in by the end of the 20th of May, so the end of tomorrow, for you to guarantee to get your payment in your bank account by the end of May. So that kind of has slipped me by a little bit. And also a reminder that to protect yourself from scams. HMRC have been quite concerned about scammers. So they're saying, look, just don't give out private information. Don't reply to text messages, and don't download attachments in emails that you weren't expecting. This is not how they operate. They look for you to contact them, or they will perhaps contact you directly. Now, it is quite tricky. I've been speaking to HMRC, and of course they phone back. Most of them are working from home, and I get a sort of an undisclosed number on my phone, so I don't really know who I'm speaking to. But just be careful. But remember that they don't often look for responses from you or for you to open up attachments, and they do want you to forward any kind of suspicious emails to their phishing. Not with a rod, but with a PH, phishing@hmrc.gov.uk, and there's also a text number 60599. Just forward those texts on if they look a bit dodgy to you. Just to be mindful of how we move forward. What's interesting is today the ONS have advised that the number of people claiming unemployment benefit soared to 2.1 million in April. So in a month, up 856,000 people, where the actual numbers claiming unemployment benefit in the first quarter to the end of March had only risen by 50,000. And that was quite an increase in itself at the time. So clearly lots of organisations, not necessarily in this sector, but certainly lots of organisations have actually not taken the furlough route and have already got rid of people. And of course, as we move to recovery, your businesses will need obviously to think about how you do use furlough where you think trading is going to go, and what your plans are. So what are you doing? How will you manage social distancing? Because that's probably not going to enable you to have everybody back at work anyway. How much phasing of the coronavirus job retention scheme will you actually need? How will you pay for it? And actually, at what point will you need to make some of the difficult decisions? I think there will, inevitably be some losses. It's debatable whether they'll be at the, at the 10% level or higher. Just thinking about what we've just said, and then just very finally, they've eventually issued the online service where you can reclaim statutory sick pay. That will be that portal will be open from the 26th of May to repay statutory sick pay that you've paid to current or former employees. That's obviously if you had a payroll scheme at the end of February, bit of a theme there, and you had fewer than 250 employees on those RTI returns at the 28th of February, then you would be a qualifying employer. And you can claim that first 2 weeks from the first day of sickness. So they've obviously not from the sort of third or fourth day. If that employee or the employees you're claiming for had coronavirus or coronavirus symptoms, somebody they lived with had those symptoms, or they were got a shielding letter from the NHS or a GP to stay at home for 12 weeks. Therefore, you can either claim back to the 13th of March if somebody had coronavirus symptoms or was self-isolating, or indeed had coronavirus itself, or from the 16th of April if they were shielding because they were told to, and there were some increased rates. There isn't the need for a doctor's fit note, but there will need to be an isolation note from NHS 111 or an NHS or GP letter saying stay at home. So you can claim for sick pay and for the coronavirus job retention scheme for the same employee, but not, obviously, for the same period of time. So somebody could have been sick and getting sick pay, and then they could have been furloughed, but they need to be for different periods of time, and obviously, in line with the appropriate notices that have been issued to people. If somebody's sick, they're sick, but clearly if they are, if they're self-isolating, then or shielding, then they might be able to come off sick pay and move on to furlough, as we've mentioned before. A couple of questions that I've received. First is, has the furlough cut-off date changed from the 19th of March? Short answer is no. So if people have been engaged after the 19th of March, and again, we've got to remember that at the 19th of March or 28th of February, they had to have been on a real-time information return. So HMRC must have known about them. It's not just that you'd employed them. They've not moved that date. So anybody who didn't meet that cut-off and has subsequently been engaged still won't qualify. So they've not moved that date, and they're not likely to move that date. And obviously, as soon as we know more about the part-time furlough scheme, we will let you know. So that was the other question I received. Do we know any more yet? No more than I've just mentioned. So, it's getting quieter, but I think it's a bit of a calm before the storm as far as the job retention scheme is concerned. But I'll pass over to Emma now, just in relation to maybe some of those legal points or some of the other things that I haven't covered.
Thank you, Nigel. Yeah, it's quite nice to have a little bit of quiet time, but at the same time, I think you're right. I think it is the calm before the storm of us getting our head around what the tapering down of the scheme is going to look like from August until the end of October. So we wait with bated breath with that. They've said it will be the end of the month, so it probably will be the end of the month. No earlier than a minute before midnight, I have no doubt. But just to pick up a couple of the more legal points, again, we are talking speculatively a little bit with the tapering down of the scheme, but what we expect to have there will be some requirement that if you are getting your employees back to work on a part-time basis, we have to remember national minimum wage requirements. At the moment, employees can do training, but they have to be paid national minimum wage, and that's likely to be transposed into, if we get them back to work, that's fine, but for that period that they're in work, we have to make sure that we're meeting our national minimum wage or national living wage obligations. A number of questions that I've been getting in relation to coming back to work, starting to think of that return to work, kind of the more legalistic stuff. We know our obligations in terms of risk assessments and what we have to do, but from an employment perspective, as an employer, you owe your employees a duty of care, first and foremost, and there's also an implied duty of mutual trust and confidence that you owe to your employee, and those are really, really important, because what we have to remember is that this is a very unheard of situation. It's not very familiar. Employees have never been through this before. So they're likely to be a little bit itchy, a little bit worried, a little bit scatty. So we need to take that into consideration when we're making our return to work plans. Clearly, we have obligations in terms of social distancing. And also there are obligations there in terms of, if we can't facilitate the 2-metre rule, what we should be doing to create a safe working environment, COVID secure environment. But what happens if you've done everything that you can do and your employees won't come back to work? And there's a number of reasons they might say this. It might be because their children's nurseries aren't open, or they're not in the relevant years going back to school. And they've got children to look after, and maybe their partner's having to go back to work. What the heck do we do then? Or you may have employees that are just worried and that are saying, I don't think it's safe, I shouldn't do it. Or you may have the category of vulnerable employees. So how do we deal with them? If you have employees with childcare issues, there is a right that they have to take time off for dependent leave. So usually that's a very short period of time where the employee is entitled to take time away from work to make arrangements for emergency care for that dependent, so it can include children. Usually that's a few hours, no more than a day, because it's not time off to look after the child, it's time off to make arrangements to look after the child. But clearly we are in uncharted territory, because there may well be not any other arrangements that they can make for the child. So here we may be in a situation where dependent leave can go on for a longer period, can go on for a week, could go on for more. But the important thing to remember about dependent leave is it's unpaid. So if you've got employees coming to you saying, well, I can't because of childcare, well, that may be okay. May not be able to get around it any other way, but dependent leave is unpaid unless you allow for paid leave in your own policies and procedures. The second situation was employees that are just a bit worried. So just a bit worried about social distancing. And the key to that is going to be communication. It's fine doing all these great things, doing all these risk assessments, getting the workplace COVID secure. Everything with employment law always comes down to that communication piece. Make sure that you're telling your employees all that good stuff that you're doing. Otherwise, you're selling yourself short, because if you're going to do something great, let's shout about it. Let's tell the employees the steps that you're taking, and that's much more likely to get them on side. And if at the end of the day you are certain, or you are as certain as you can be, that you have acted reasonably, that you've done everything that you can do to make your workplace COVID secure, and you still have employees that are refusing to come back to work, it may be that you have to go through a disciplinary process with them. Kind of government health warning there is, we may have lots of factors in play that we just need to consider, but that may be the ultimate goal with them. And then the final category of employees I spoke about were those employees who are either considered vulnerable. So that's employees who are 70 or over, who are pregnant, or who are under 70 but have an underlying health condition, so they're entitled to the flu jab. Those guys, they're not entitled to statutory sick pay if they have to remain away from work. And the reason for that is that they are not unable to work. It's been suggested, it's been advised to them that they should keep social interaction to a minimum, but they can work from home, and actually they can work in the office. They just have to be, or the dealership, but they have to make sure that they're being careful. And what we have to remember for those employees is that they almost have the first bite of the cherry. They get the first pick of the jobs that's going to make them more socially distant. So that's the thing to remember for those guys. But if they still can't come to work, or they're not happy, you're not comfortable, we can't facilitate it, they're not entitled to SSP. They can continue to be on the furlough scheme insofar as whatever shape it looks like after July. Or we have to look at how and when are they going to stay at home? Are they going to use holidays? Is it going to be paid, unpaid? What's that going to look like? But it's not SSP. Those employees who are extremely vulnerable, they're the guys who've got this letter from the government. They are entitled to SSP. So they can't leave the home. They're shielding. If they can't work from home, they're still entitled to receive SSP as normal. So slightly different kind of challenges that we're going to start to see as employees start to come back to work. We know that 99% will be great and they'll muck in and they'll help out, but there's always that 1% that are a pain in the proverbial backside. So we need to just be ready for them. And the only other point to pick up from what Nigel said relates to this additional guidance that we've had about payments to be included in the furlough pay. I'm really very pleased to say it was as we had looked into our crystal ball and predicted, because otherwise you'd have been seeing me with my head in my hands, I think. The basic principle is that the government have implemented a fantastic scheme in the coronavirus job retention scheme. They are paying out lots. They are trying to do their best for the businesses in order to retain employees, to keep businesses going. But they have made the fundamental error of trying to implement a very black and white scheme into, and I've said this before, employment law, which is completely full of grey. And now we're starting to see them understand a bit more about how employment law works and try and fit the scheme around it. But it is as we originally advised. Anything that is contractual is payable or is reclaimable under the scheme, and that's going to go beyond just what the contract says, because in employment law we're the only area of law that have this very strange situation where the contract can say this is completely discretionary, but actually it's been paid for a long time. You can't really stop paying it, otherwise the employee is going to go up in arms, therefore it's implied into the contract. So it is a funny area, and it is, if you are unsure, it is something worth kind of coming to take a bit of advice on. It's not a long piece of advice, but it is well worth it if you're unsure. If you're not, it's exactly as we advised, and you can crack on with your claims from there. So those were the bits really that I had to raise. There's a lot more to say on employment law. There's a lot more to say on returning to work, and if we get to it, redundancies. But that's it for today. Over and out from me.
That's great. Thanks, Emma. And anything else, Nigel, or anything on PAYE and deferrals at all? Nigel, your other hat?
Yeah, so just picking up on that. So PAYE deferrals are still very live. So that was HMRC, are quite happy to accept deferrals almost automatically. So that's a 3-month deferral without any questions on time to pay. They do just still want you to phone up, so that there's a separate sort of coronavirus helpline, but they want you to sort of phone up round about the 19th to the 21st of the March, so 21st of the month, when the PAYE is actually due, and just do it that way. So rather than some of the VAT things, which is kind of auto deferred, still do your payroll, still send in the real-time information, assess the amounts that are due, and obviously call them and seek that deferral. Clearly that's fine for sort of March payments, April payments, and we're expecting for May, but we will update what happens beyond that, because there will come a time when they'll move from the informal deferral scenario that they've got at the moment back to that formal time to pay arrangements, where you've got to show that they're not the only ones taking the pain, so to speak. But yeah, that's where we're at. So just don't forget to make those calls and get that money deferred.
That's great. Thank you, Nigel. And thank you very, very much again, Emma. Just briefly touching on property and obviously interaction with landlords, deferrals, etc. So over to you, Bill.
Yeah, morning everybody. We're seeing a rising level of landlord and tenant engagement as we're approaching the 24th of June quarter day in respect of rental payments. This is encouraging, but there's no real uniform solution we're seeing beyond the willingness generally by landlords to accept monthly terms. I think that as we approach the reopening of dealerships and there is some clarity about trading recovery, landlords will be more willing to grant concessions as they can see an opportunity for remuneration down the line, further on down the lease. So I think some of the things that they're looking for is questions that we're all been dealing with and everyone is asking is what's going to happen about the delivery and handover and selling of cars, seeing activity happening in dealerships, what that activity will be. It's been mentioned earlier about after sales probably leading the way. I also think it's worth pointing out that for landlords, other sectors, in particular retail and hospitality, are perceived as much greater problems than car dealerships. And I think that's something for all of us to exploit in the context of there is a recovery story here. I think Martin mentioned about structural changes. And so it's fair to say that often we're having engagement with landlords and we're pointing out the effect of this crisis is possibly to fast forward structural changes that were underpinning the market anyway. So as such, as we emerge from this, we are going to enter a world of changes with electric vehicles in particular and other things happening that much quicker. And to try and present a story of some excitement to landlords to engage with them. So I would encourage people in presentations to landlords to try and desist from the sort of cutting off of the legs approach to trying to present something that's more upbeat, that is offering them something down the line. And on that basis, and as I said, in compared to some of the issues that they're dealing with, we're all more likely to get a favourable reaction. And then something I think I mentioned, Steve, last week, it is important that in these engagements that there is some form of presentation, which is talking about how each group, each dealership is expected to start recovering. And in that way, landlords can see that any concessions that they grant will, as I've said earlier, provide benefits down the line. So to conclude, I think it's really good news that everyone's talking about getting back and trading, and landlords will see that, and that needs to be conveyed to them. I think there's a much greater level of engagement between landlords and tenants than there probably was 3 or 4 weeks ago, and I think that's very, very good news. And I do genuinely believe that there are opportunities for rental deferments and possibly other lease restructurings, but tenants should, where possible, be positive. Thank you, Steve.
Thank you, Bill. Anything to add, John?
Just very quickly to support Bill's point there, that if you're looking to move to monthly payments as opposed to quarterly, that has been generally supported by landlords. And just to re-emphasise something Bill said there, that if you are looking for a rent holiday, let's say of 3 months, rather than just saying, let's add that 3 months to the end of the lease, maybe looking at a kind of regearing of adding 6 months or longer, which gives the landlord something maybe to think about, which could get a more positive response. That's all, Steve.
That's great. Thank you again, Bill and John. And finally, Andy, so it's been a couple of referrals to cyber, HMRC from Nigel. Anything else to add on cyber, GDPR, Andy?
Yeah. Good morning, everybody. So again, just coming back on the COVID-19, The whole dark web is all about exploitation of human behaviour. Yes, we've seen it this week with the job retention scheme and that Nigel mentioned earlier. Interserve, they've had a data breach for 100,000 records this week, reported, and vigilance again is key. Also, the first signs of hacking into some of the supercomputers. They've had incidents now within the academic areas and research and universities that the NCSC are reporting. And also from a suspicious email reporting services, the National Cybersecurity Centre have now got a simple note to send to. So if you do have any suspicious emails, you can now send it to report@phishing, again, ph.gov.uk. Again, we would encourage that to work with that. And also, just coming back on the COVID-19, I think we now see a further statement. We've been working to try and bring together a number of solutions, which again I'll report back on at some point during the week. So thanks for that, Steve.
Thank you, Andy. That's everyone then. So once again, in the interest of time, just very quickly, I'd like to thank all the presenters and everyone again for joining the call. There'll be a recording out today, executive summary document tomorrow. There's a few things we agreed to provide, or the presenters agreed to provide, such as Leigh Cohen's checklist and various other things. We will continue on number 11 next Tuesday, same time. And again, I hope everyone, wish everyone the best and stay safe. Thank you. Goodbye.